In the UK, landlords must navigate a complex landscape of taxation on rental income. Understanding these tax obligations is crucial for legal compliance and financial planning. This video delves into the intricacies of property tax, specifically for rental properties in the UK. We will explore various components such as taxable income, allowable deductions, calculation methods, the impact of property allowance and allowable expenses, national insurance implications, and legal compliance. This video aims to provide landlords with a clear understanding of their tax responsibilities, ensuring they can manage their rental properties effectively and lawfully. Property tax for rental properties in the UK is a significant aspect of being a landlord. Unlike personal property tax, which is often tied to the ownership and value of a property, tax on rental income focuses on the revenue generated from letting out a property. Landlords are taxed on the profit made from renting out their property, which means the income received minus the allowable expenses. The UK's tax system distinguishes between residential and commercial properties, with different tax implications for each. For residential rental properties, landlords must consider various factors, including rental income, the type of property, and their own tax status. This may involve different rates and allowances, depending on whether the property is let furnished or unfurnished, and whether the landlord is renting as an individual or through a company. Understanding these nuances is vital for effective tax planning and compliance. It is important for landlords to stay updated with the latest tax regulations, as changes in law can significantly impact their tax liabilities. In the following sections, we will explore in more detail the components of rental income that are subject to taxation, the allowable deductions, and how to accurately calculate the tax due on rental properties. For UK landlords, understanding what constitutes taxable income from rental properties is essential. Taxable income includes the rent received from tenants, but it also can encompass other sources of income related to the property, such as payment for additional services, like cleaning of communal areas or hot water and heating. However, not all income is subject to tax. For example, the first $1,000 of income from property rental is tax-free. A relief known as the property allowance. Equally important are the allowable deductions, which reduce the taxable income. These deductions can include a variety of expenses incurred in the running and maintenance of the property. Common examples include letting agent fees, property repair and maintenance costs, utility bills if paid by the landlord, insurance, mortgage interest payments, and council tax. These expenses must be solely for the purpose of renting out the property to be considered allowable. By accurately accounting for these deductions, landlords can significantly reduce their tax liability, making it crucial to maintain detailed records of all income and expenses related to their rental properties. This section has outlined the foundational concepts of taxable income and allowable deductions, setting the stage for understanding the actual calculation of tax on rental income. The calculation of property tax on rental income in the UK depends on the landlord's total income and tax rate. After deducting allowable expenses from the rental income, the remaining profit is added to the landlord's other income to determine their tax rate. For instance, if the profit combined with other income falls within the basic tax rate band, the landlord will pay 20% in tax on rental income. It's important for landlords to understand their tax band, as it directly influences the amount of tax they owe. They should also consider the impact of any changes in their income, whether from rental or other sources, as this could shift them into a different tax band, altering their tax liability. Calculating property tax can be complex, especially when dealing with multiple properties or fluctuating incomes. Therefore, it's advisable for landlords to seek professional advice to ensure accurate tax calculations and compliance. In the UK, the property allowance is a tax exemption for the first $1,000 of income from property rental, a beneficial provision for small-scale landlords. If the annual rental income is less than $1,000, the landlord is exempt from paying tax on this income. However, if the income exceeds this threshold, landlords can either deduct this allowance from their total rental income before taxation or deduct their actual allowable expenses. Allowable expenses play a pivotal role in reducing the taxable rental income. These include costs incurred in the maintenance and running of the property, such as repairs, utility bills, insurance, and interest on mortgages. By accurately claiming these allowable expenses, landlords can significantly reduce their taxable income, thus lowering their tax liability. It's crucial for landlords to keep detailed records of these expenses to substantiate their claims during tax calculations and filings. Regarding national insurance, UK landlords must be aware that profits from rental income could be subject to Class 2 national insurance contributions if the activity qualifies as running a property business. This typically applies if being a landlord is a landlord's main job, they rent out more than one property, or they're buying new properties to rent out. However, if renting property is not a landlord's main job, and they do not meet other criteria of running a property business, national insurance contributions may not be applicable. Landlords in the UK must adhere to a range of legal obligations regarding property tax. These include accurate reporting of rental income, timely tax payments, and compliance with evolving tax regulations. For instance, changes in April 2024, such as the removal of landlord-to-tenant payments from the scope of the construction industry scheme, can affect tax responsibilities. Non-compliance can lead to penalties and legal repercussions. Therefore, it's crucial for landlords to stay informed about current and upcoming tax legislation, seek professional advice when needed, and ensure all tax-related affairs are handled diligently and in accordance with the law. Ultimately, understanding property tax for rental properties in the UK is an essential part of being a responsible landlord. From recognizing what constitutes taxable income and allowable deductions to accurately calculating tax liabilities and understanding the impact of national insurance, landlords must navigate a myriad of rules and regulations. Staying informed and compliant with the latest tax laws, including the anticipated changes in 2024, is imperative. By doing so, landlords can not only avoid legal pitfalls, but also optimize their tax position, ensuring their rental ventures remain both profitable and lawful.